Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another review of velocity banking, but as broke millionaires. And you can see right here, there's an article from 1 week ago, how a couple in their 40s worth 1 million could still be broke, according to self-made millionaire money experts. And the reason why you might go broke is because even though you have a lot of assets, and also a lot of incoming coming in, you might not have cash flow. And in rental real estate, the reason why you probably won't have cash flow is because you have debt. So that's what we're going to talk about today. We're going to learn and review velocity banking, which is a debt payoff strategy. So let's just start from the top. So here I have the income of a millionaire, right? So if you put that in an after-tax calculator, it's about 24 grand a month. We went over this last time, but now we're going to do a little bit different where we're broke, right? So in the previous video, we're a little bit positive here, we're a little bit negative. And I say this, right? Having income is very, very valuable even when you're broke, because I would rather make 24 grand a month and be broke than someone who makes like 5 or 6 grand and is positive, let's say $300, right? Definitely would be 24 grand and negative 200 rather than $5,000 a month and be positive 300, right? Because when you see this strategy, you're like, oh my goodness, even if you're negative cash flowing, we can do so much with income. And that's what people are afraid of because they have this limited mindset that I can't make more income. Oh no, you can. Because if they give you income right now at your level, it's like giving the Excalibur to someone who's not King Arthur, right? Like, and that's what happens to lottery winners. They're given the quote Excalibur, lots of money, and they somehow screw it up, right? So we have to understand, before we get the money, we understand strategies like velocity banking to learn how to manage our cash flow. Okay, so two requirements for velocity banking. Number one is the budget. Number two is the line of credit as your main operating account. So what's a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. That's all a line of credit is, right? So if you take a look here, I recently got access to this $280,000 line of credit. I think last Friday. It was pretty sweet. So it's been about a week since I've had it. And then I also have other lines of credit, like this $15,000 personal line of credit. So the cool thing about these lines of credit is that I could use it to pay anything, right? So if I have a $10 bill here, I just withdraw $10, pay it back, bill satisfied. It's crazy. I actually did this with this $15,000 line of credit, so that I had $30 due. I said, well, it's going to take a couple of days to transfer the money. Let me pull out $30 and pull it back just so that, I don't forget to pay the bill, which I did. It was crazy, right? So that's why lines of credit are great because it gives you ultimate flexibility in managing cash flow. And credit cards are a line of credit, but we know that credit cards are a little bit unflexible. Loans are a one-way street, right? Loans are not lines of credit because when we pay a loan, we never really get that money back. So what we're going to do is, with the help of a line of credit, pay off all of our debt. It's okay if it's higher interest. So, some people might say, well, I got a 6% auto loan or a 4.5% mortgage. Why would I use an 8% line of credit? Because interest rate is not the only factor that affects how much in total interest that we pay, right? Especially when it comes to amortized debt, it's the interest rate, the term of the loan, and the original loan amount. And people, all they do is focus on interest rates. The housing um, market, is greatly affected by interest rates, but me, I don't really care. Like, I don't pay attention to that because I know that if I know how to manage my cash flow correctly, especially as a fake millionaire on paper right here, like, I'm just kidding. Well, I'm not millionaire, but I did pay off my house in 3 years. Flexing. Anyways, so let's go ahead and do velocity banking. So again, we have a budget. We list all of our debts. We have $330,000 in credit card debt and 1.44 million of debt in total. Okay, so we assume we have the same income. Now we're going to do something that people would be considered crazy because how many times have you heard, yeah, let's have 3 to 6 months of savings or savings and expenses? So what's 3 to 6 months here? It's probably at least, I don't know, 60 grand, 60 to 100 grand. And no way are we going to save that, right? So what we're going to do is have zero savings. We're going to copy the same expenses for velocity banking. Okay. And now what we're going to do is have something called cash flow. And the whole goal of this is to show how if we use our line of credit as our main operating account, that's the key words here. It's not just having a line of credit, because let's say I had a $350,000 line of credit. I'm broke. I got all my credit cards maxed out, and somebody said, "Here, you get a $350,000 line of credit," and then you had now like a $5,000 emergency because your car broke down. You got to get it repaired. Well, if you do it the average American way, then it's just an extra payment, right? So it's just like an additional, I don't know, $50 to $100 payment, and so now you're going to be more in the negative. Whereas the velocity banking, it's not just having a line of credit; it's having our line of credit as our main operating account. That's the key words here, right? So the next step to this is that we got to shuffle some debt from our from here into the line of credit so that we increase our cash flow. And the quick hack or shortcut is to start off with credit cards and short-term loans, right? If you're able to move that debt into the line of credit, then we can definitely increase our cash flow. So if we take a look here, we have let's assume that we have a $350,000 home equity line of credit. Now what's crazy is I'm not a millionaire, right? But I have access to $280,000. So I don't know if the bank would actually give you this if you're broke, but you make a lot of money, or maybe you just get like a personal line of credit for that much, right? So it could happen, and you might be broke because um, lots of nice things. You wanted to travel. You wanted what's it called? Get a how much is a $65,000 car? I probably need to look it up on Google what you can buy at 65. But that's probably a luxury vehicle. You went to med school, so you became a neurosurgeon, and you need the $800,000 house in the southeast, right? So those are nice houses for 800,000. We're not living in San Francisco where we get like a $1.2 million single family home for a shack. Probably $2 million in San Francisco, right? Okay, so let's go ahead and assume that we have a $350,000, kind of like a credit card, based on your home. And I think with this income, even when you're broke, maybe you might be able to get it. Because I always say in the videos, like, hey, banks don't lend money to people who need it. But the fact that I don't know, I'm curious now if they would actually lend. But I just know that in order to look attractive to banks, you always got to get the line of credit before you need it. So this is the only unrealistic part. No one's going to give you a line of credit at this stage of your life. But let's assume that maybe we got lucky, and some people do get lucky. Don't get me wrong about that. They get lucky in two ways. Number one, no doc loans, right? Like no doc, you get a no doc loan, and again, don't lie. Don't ever lie to a bank, right? Because you don't want to go to federal, pound me into a prison. But there's no doc loans out there, I think. And then number two is you probably got the line of credit way before you needed it, and then like you just kind of piled on debt without knowing how to properly manage it, right? So let's move these credit cards. So that's $330,000 of debt. Was it 330? No, I think this is wrong. I'm sorry. It's 140 plus 150 plus 80. So it's 370. My bad. My bad. 370. Okay. So 370, and let me just go ahead and I have this correct, plus 65 plus 250 plus 800. So actually that's 1.48 million. Okay, I gotcha. I just modified this last time because, or I from the previous one, so I think these are the previous numbers of the amount that I have. But okay, $370,000 of debt. So let's just, for the purpose of this demonstration, just assume it's 400,000, not 4 million, but make it easy on ourselves. But I think if we have this much income, $1 million of income a year, we could probably easily get $1 million line of credit, or four. I don't know. I got $500,000 lines of credit. So now that I'm like doing this scenario, I'm like thinking like, man, $500,000 in lines of credit is pretty small, right? That's what happens when you make more money. Like, you ever hear that? Like, oh, if you make like $100,000, then you think about how everyone else is making $1 million. And if you're making $1 million, you're always thinking about, man, everyone else is making $1 billion. And I guess if you're a billionaire, what do you think? Like, you need to make more? I don't know. All right, so now let's go ahead and move this. So this is going to be $370,000 as a broke millionaire. We'll move it into a line of credit, and by moving these three credit cards, guess what happens to these payments? Zero, zero, zero. So look at that. We went from a negative savings balance because we probably did an overdraft or something of some sort to 12 grand in one swoop, right? And so now what we're going to do is we're going to put our entire paycheck into that line of credit, meaning instead of just paying the minimum, we pay the entire 24 grand into that line of credit, and then we take our expenses out of the line of credit, right? And then after every single month, our cash flow is going to be used to reduce that line of credit, right? So we're not in this struggling situation anymore. So this is what I call the financial fitness stress test, right? So if you're making all this money and you're broke to the max because you got all this debt, how do we go from here to here in an instant, right? So now let's go ahead and do this. So let's do the calculations that we always do. So to get the next month's balance, the previous month's balance plus the previous month's interest minus our cash flow, 122,216.18. Okay. Did I put an extra zero? 122. All right, that makes more sense. Okay. So now let's go ahead and take the average daily balance, and we take the average here, right? So average, multiply it by the interest rate, which is 0.08, all right? So that's the interest rate of my home equity line of credit. But you're not paying 29 grand a month. You divide by 12 because it's calculated monthly. So not bad. Okay, so now let's go ahead and copy and paste these numbers, right? And so now let's go ahead and do this. All right. So here we go. And it's 34 months, right? So 34 months to pay off 370,000. So let's see, 34 months, 370K. Not bad, right? Not bad as a broke millionaire to be able to pay off $370,000 of credit card debt in under. I should expand this. Maybe look neater. In under 3 years, right? Not bad. Okay, so now we got the student loan, auto loan, and the mortgage, right? So I really wonder what kind of car I would buy at 65,000. But luckily we got this loan calculator, so we can calculate at 34 months what the current balance is. So we got the auto loan, student loan, mortgage. We just put in 34 months here, and it tells us what the current balance is. So 30 grand, 195 for the student loan, and 761. So if you don't know what this thing called the CFI, cash flow index, is, just think of it as a ranking system of what the order of debts that you pay off. So if I look at this 30 grand, if I focus on paying off this 30 grand, I get $1,200 a month of cash flow. Whereas if I pay off the $761,000 of debt that I have remaining, I only get 4,000. So which one gives you more bang for your buck? This paying off this 30 or paying off the 761? I'm going to pay off this 30, but the reason why people are so focused on the mortgage is because it's emotionally tied to something that you value, which is your home, right? But the mortgage. This is why people say pay off your mortgage last, or not at all. But I wouldn't recommend. I personally wouldn't recommend not paying it off at all, just because there's a lot of interest that you pay. And if, for example, if you take this to the full term, $695 to $59,000 in interest, along with the $800,000 principal, right? So let's focus on paying this one off first. So we're just going to move this 30 grand into the line of credit. So 30 grand. So let's go ahead and move this here, 30 grand. All right. And actually, let me make the font a little bit bigger. What font size is this? Let me just quickly check. 16. So we're going to make everything 6, 10, and then 16. Okay. So does it look big? All right, cool. So now let's move this 30 grand here plus 30566.34. Okay. And by moving this 30 grand of debt, guess what happens to our cash flow? It increases by $1,200 because now that payment isn't really there when we move that loan into the line of credit. So this is now zero. And so what's our new cash flow? It's about 13 grand, right? So exciting times. And so now we can easily see, okay, we can easily see here. Whoopsie, I screwed up. Okay. All right. So we can easily see here that we're going to pay this off. So our new cash flow is 13472.81, right? How long is it going to take to pay it off? Ho ho ho! Look at that. 1, 2, 3 3 more months. So it's going to be 37 months completely paid off. And look at how little interest we pay. Oh my goodness. All right, so now 37 months. So that'll be 370 plus 65. So that's 435K. Okay, 435K. All right. So now the next thing is the student loan. So let's calculate what the current balance of the student loan is. Go back to our loan calculator. So this is now zero. This is going to be 37, 37. And then we take a look here. It's $190,000. So you look at the CFI. The range of the cash flow index matters because if you just do a quick Google search, it says 0 to 50 is you want to pay off 50 to 100. It's like meh. And then anything above 100 you don't want to pay off. Now, again, like I said, cash flow and the amount of interest that you pay is like inversely proportional. So the more cash flow, the less cash flow something takes up, the more interest you pay, which is why I recommend paying it off. But or what I would do personally is pay it off, but pay it off last. Okay, so let's go ahead, and I'm okay with just paying this off, but in real life, I don't think I would actually move the entire balance into line of credit, but because this is just, I don't want to be here all day, and I'm just going to show what I would actually do with any amortized loan, especially at a lower interest rate. And actually, this one is 7%, so it's very close, but it's still not. I still don't. If this were me in real life, I wouldn't move it into a line of credit. But we'll just go ahead and do that, just for demonstration purposes. Make this easy, and then let's do that. So now what we do is we move the whole 190,545, right? And then so now what's our cash flow? Okay, so what's our cash flow? So we get $2,900 in cash flow back. And now we got 16 grand in cash flow because that student loan's now gone, right? So let's go ahead and do this right here. And I'm going to copy and paste. So our new cash flow is about 16 grand. So now it's going to be 16375.52. Okay, so now let's go ahead and copy and paste. And in 49 months, we completely paid it off. Not bad. All right. So 49 months. So 49 months. And so it's 435. So it'll be 685K, right? I think. Hopefully I'm doing this right. And then now all we got to do is we got the mortgage, okay? So we got the mortgage, and this is the last thing that we have. And at this point you have so much cash flow, 16 grand. You don't have to necessarily pay it off, but if you do, you get 4 grand of cash flow back, right? So let me just kind of go here and go to 49 months. And then you can see, wow, you already paid $142,000 of interest. That's a lot, right? And so I don't want to have to pay 600 and whatever $1,000 of interest. So I'm okay with paying it off. Now, there are two things that you may have heard on the internet about using velocity banking to pay off the mortgage. The most important thing to understand is the mortgage is usually paid off last because of the cash flow index, right? It sucks up the least amount of cash flow per the balance of the loan. But also, we don't want to replace the mortgage because of the same fact that it gives us such little cash flow. So if I put the $743,000 of a loan from a 4.5% to 8% loan, and I'm only getting $4,000 back, there's not enough cash flow to offset the amount of the loan, right? So even though interest rate quote doesn't matter, it does in this case. But when you do chunking, which is just chopping up the loan into pieces, it really doesn't matter. That's the crazy thing. You can even use a 30% credit card, and it'll turn out better than like a 10% line of credit. From 4.5 to 10% line of credit first lien HELOC replacement, right? So let me go ahead and open up the velocity banking calculator to kind of demonstrate what I mean by that. All right, here we are with the velocity banking calculator pre-filled out. And so I got this from Renatus, and actually I've been studying a lot of their material. So not only do they do velocity banking, they also have tax and legal. A lot of people all they think about is like, oh my goodness, velocity banking. But guess what? If you overpay for a property like in California, do velocity banking, it probably do more harm than good, right? So velocity banking is just a tool in a toolbox, but you probably need to learn. And again, I may be biased because I learned, I've learned this for like 7 years now, And I know what happens is people get so enamored, like, oh my goodness, velocity banking, like, but don't you want to learn like tax and legal, understanding credit, and all that other good stuff? Well, that's where I learned it here from Renatus. And full disclosure, I actually sell their products and make a commission, right? All right, so here we go. So here's the point of this exercise, right? Don't replace your mortgage with the first lien HELOC. That's all it is. So this chunk amount is all it means is how much are we moving to line of credit. So if we do a full replacement, 743,448.38 into, let's say, an 8, we'll do 8% line of credit, 8%. Okay. So you'll be like, oh, wow, 3.5 years, that's really good because it's a 30-year mortgage. Okay. Yeah, that makes sense. But if you take a look here, we're paying $112,000 of interest. And so let's just do a comparison of a first lien HELOC replacement. So that'll be 3.5 years and then 112K of interest. Now, if we do something called chunking, which is just doing it into pieces, right? All you got to do is just take an amount that's just very similar to your income, throw it to from the principal line of the loan to the line of credit, and this is gonna help you pay it off faster because um, oh, hold on. Well, let me rephrase this. It's actually going to help you pay it off faster because it's actually going to make it easy for you to do it and prevent something called a segregation of income, right? So a lot of times people don't understand like why am I making money and still broke? It's because your income is segregated. So a lot of people don't think that's like real, but you got to see the emails that I get from random people. It's like, oh my goodness, I'm making a lot of money and I'm broke. And I even did a live stream of paying someone's, how you would hypothetically use Velocity Banking to pay someone's debts. And there was like 22 debts in the spreadsheet. It was crazy, right? So let's just put like 25 grand. Okay. Whew, look at that. We saved about 68K or 58K, right? Or we only paid 58K. So if we do a second lien HELOC, and then chop it up into pieces, it's just 3.3 years and then 58K. So what's 112 minus 58? Minus 58. That's 54K. So again, as a broke millionaire, maybe 54K is not that much, but to someone who's in the poor middle class suburbs where they think they're okay, but they're really not, that's a lot of money, right? Remember those commercials where it's like send a what's it called? Dollar to like those countries abroad where they're not doing so well. Well, maybe you got to do that for your poor suburban. I don't even know what to say. You know what's funny? Like I remember a long time ago, I used to watch movies like Fight Club, Office Space, and then all those movies were kind of like counterculture. I think that's why I was so lazy for like a majority of up to my late teens and early adulthood because I was just like I don't want to be like the man, right? Because and then when now that I become older, I was like I think I should be responsible in learning about this stuff, right? Because you could either just die broke as a joke or at least you could live a somewhat comfortable life. Hopefully that makes sense and I'm not just going random tangent. But okay, I don't even know if I have a point to this, but my point here is you don't want to do a first lien HELOC. Okay, so first lien HELOC, yeah, you might pay it off faster, but if you're in like the traditional middle class income and you're thinking of doing the first lien HELOC, it just doesn't make sense. And even as a millionaire, it still doesn't make sense. I mean, who wants to leave 50 grand on the table? Nobody, right? So hopefully that makes sense as a broke millionaire. And if you're not a broke millionaire, just imagine that you are, right? What would you do with $58,000 left over? Okay, so let's go back here and then just type in, what was it, 3.3 years? Yeah, let's just type that in. So now we got here, so 49 divided by 12 plus 3.3, that would be 7.38 years debt free and to pay off 1.48 million. Not bad, right? And so now this is going to go to zero. And now we got the oodles and oodles of cash flow, 16 grand. So we still have $4,000 of general expenses, but all our debts are paid off. Actually, it's not even 16 grand. See, when you have the velocity banking calculator on, because I think it has so many calculations in the background, it actually affects the other spreadsheets. But Now we got 20 grand of cash flow a month, and we're gonna have rich people problems where we feel nervous about having all this money in a savings account because like it could grow if I invest it, right? So that's the dream, the rich people problems. Okay, all right. Well, that's it for today. So have a happy Saturday. Practice your velocity banking spreadsheets, and if you have any insightful moments, because I've been doing this for a long time, and I've known about velocity banking for since 2017. Sometimes you do things too much, and you forget like what makes it insightful for other people, and that's like, oh, it's just an everyday thing, right? So, for example, in maybe in your reality, speaking English is very normal and easy, but for someone who's not from here, like that would be the most amazing thing if they could speak English fluently. You know what I mean? That's just how life works, right? So if you have any insightful boom moments or kabam or wablam, splash, flash, one of those Batman noises, insightful moments, leave a comment. Or if not, just enjoy the video, do the spreadsheet, pretend you're a millionaire, and we'll have good times from there. All right? Have a great day, and we'll speak next time.